So way back about 25 years ago, we began hearing about the 4% rule, which is the idea that a retiree can withdraw 4% of a portfolio's original value per year and still be reasonably certain that their money will last as long as they do. Whether that works or not is dependent on many different factors, but it's a guideline that may be a decent starting point for someone who's looking to fund 30 years worth of retirement from, say, age 65 to 95. But what if you're a lot younger than that, maybe in your early 40s or even younger, and you'd like to retire at that age? How well does this 4% rule hold up? Well, let's say you're 40 years old and you decide you need about $100,000 of annual income with a 3% adjustment for inflation each year. That means you need a $2.5 million nest egg, which at a 4% withdrawal rate, potentially giving you $100,000 per year, which is what you needed originally. So what could go wrong? A lot, as it turns out. So first, your money's got to last for about 55 years instead of 30 years. And if you're taking systematic withdrawals from your portfolio with a 60-40 mix of stocks and bonds, if the market performs poorly through the early years of your retirement, your money could very quickly run out. That's called sequence of returns risk. Next, if interest rates and economic growth remain low, we could be facing lower market returns than what we've seen in the past. If your money has to last 50 years or more, market returns become even more critical. And third, with so much time ahead, you've got greater risk of unexpected spending shocks like healthcare issues or large home repair. These things can really eat into your nest egg. And at age 40, you're also 25 years away from Medicare, which means you've got to fund your own healthcare needs. Not cheap. All this means that the younger you are when you retire is that a 4% withdrawal rate may be far too aggressive. An analysis by the Capital Group companies determined that the maximum annual withdrawal rate for a 40-year-old should be roughly 3.38%, and it goes down to 2.79% if you factor in spending shocks and lower future returns in the market. So instead of $2.5 million, it could be closer to $3.6 million or even $4 million that you might need to get that $100,000 per year of income. So keep all this in mind if you want to retire early. With a longer retirement to fund for, there's potential for a lot more uncertainty. This is yet another reason to talk with an advisor, and you've got to have a strategy.